How do economic downturns affect commercial bank profitability? Imagine a period when economic activity slows down significantly, businesses cut back on investments, and consumers tighten their spending. This scenario often signals an economic downturn, a phase that can have profound effects on the financial sector, especially on commercial banks. Understanding how these economic shifts influence bank profitability requires examining several interconnected factors. During an economic downturn, the primary challenge for commercial banks is the increased risk of loan defaults. As businesses and individuals face financial hardships, their ability to repay loans diminishes. This leads to a rise in non-performing loans, which are loans where the borrower is not making interest payments or repaying principal as scheduled. When non-performing loans increase, banks must set aside larger provisions for loan losses, which directly reduces their net income. Additionally, economic slowdowns often result in lower interest rates set by central banks to stimulate growth. While lower interest rates can benefit borrowers by reducing borrowing costs, they also compress the net interest margin for banks. The net interest margin is the difference between the interest income generated from loans and the interest paid on deposits. When rates decline, banks earn less from their lending activities relative to what they pay on customer deposits, squeezing profitability. Furthermore, during downturns, banks tend to see a decline in loan demand. Businesses and consumers become more cautious, leading to fewer new loans issued. This reduction in lending activity diminishes the bank's interest income and fee income from loan origination and other banking services. At the same time, banks may face increased operational costs related to managing distressed assets and conducting more rigorous credit assessments. Market volatility during economic downturns also affects banks' investment portfolios. Fluctuations in asset prices can lead to unrealized losses on securities holdings, impacting overall profitability. Banks may also face increased regulatory scrutiny and pressure to bolster capital reserves, which can limit their ability to lend and generate income. Despite these challenges, some banks can mitigate the negative effects through diversified revenue streams, strong risk management practices, and maintaining adequate capital buffers. By carefully managing their loan portfolios and controlling operational costs, banks can navigate economic downturns more effectively, preserving profitability even in tough economic times. In summary, economic downturns tend to reduce commercial bank profitability through increased loan losses, compressed interest margins, decreased lending activity, and market volatility. However, strategic management and resilience can help banks withstand these periods and emerge stronger once economic conditions improve.